Small cap, large cap, value, and growth. Small cap mutual funds are funds that invest in companies with a market capitalization of less than $2 billion determined by a simple mathematical process, multiplying the current share price by the number of outstanding shares. Small cap companies are often younger, less established businesses that may have the potential for high growth. However, they can also be more volatile and less liquid than larger companies. Small cap companies are riskier investments than large cap companies, especially during economic downturns. They are less able to handle a sharp decrease in demand. Volatility. Small cap stocks are more volatile than larger stocks. Performance. Small cap index funds can outperform the S&P 500 over the long term. Shortcomings. Smaller funds can have higher operating expenses and can be misleading due to the impact of a few successful stocks. Track record. Investors can avoid being misled by short-term performance by checking a fund's track record over a few years. Diversification. Smaller funds are less diversified, so poor performance by one stock can have a big impact on the portfolio. Large cap mutual funds are funds that invest in companies with a market value of at least $10 billion. These companies are typically more established, less volatile, and have a history of stable growth and consistent dividends. A few things to know about large cap mutual funds. Large cap funds are often forced to imitate blue chip benchmarks like the S&P 500. This is because mutual funds are restricted to owning no more than 10% of a company's outstanding shares. Large cap funds can be a good investment tool for investors who have long-term holding periods. Some of the large cap securities you may have heard of: Apple, Microsoft, Amazon, Berkshire Hathaway. Large cap mutual funds are generally better for long-term growth, while small cap mutual funds can be good for investors who are willing to take on more risk for potentially higher returns. Value funds. Value funds generally seek to find stocks that are inexpensive on the basis of a standard fundamental analysis yardstick such as earnings, book value, and dividend yield. Value investing is based on the idea that investors can save money by buying stocks that are trading at a discount to their intrinsic value. Value funds often have lower price-to-earning ratios, higher dividends, and lower price-to-book ratios than growth funds. Value funds are often managed with a long-term investment horizon in mind. Value funds typically have a lower risk profile than growth or aggressive growth funds. Growth funds. Growth funds are investment portfolios that focus on companies with the potential for rapid growth and capital appreciation. Growth funds seek to find companies that are expected to show strong future growth in earnings, even if current earnings are poor or even non-existent. Growth funds invest in stocks of companies that are expected to grow faster than the market as a whole. These companies often reinvest their earnings into expansion, research and development, or acquisitions. Growth funds are often characterized by higher price-to-earning (PE) ratios and little or no dividend payouts. Growth stocks can generate significant returns, but they also carry higher risks due to market volatility. Growth investors evaluate a company's potential for growth using a combination of objective and subjective factors plus personal judgment. Some examples of growth stocks include Netflix, Amazon, Nvidia, Microsoft, and Tesla.